Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and we got a special guest today. We're going to really be covering the precious metals this week and following what's going on. I mean, we're in the middle of a really exciting bull market. Gold hit $2,000. Silver hit $30. And in quite a quick fashion here, we saw this massive run-up. It seemed like there was no end in sight. And this week, we did see the correction. And I can't think of a better person to talk to about the nature of these ups and downs than Alasdair Macleod. He's a returning guest. He's with goldmoney.com, and he's been a stockbroker since 1970, a member of the London Stock Exchange in 1974. And his experience encompasses equity and bond markets, fund management, corporate finance, and investment strategy. And after 27 years in the city, Alasdair moved to Guernsey. He worked as a consultant at many offshore institutions and was an executive director at an offshore bank in Guernsey and Jersey. And now he's with us here. He's with goldmoney.com. Check him out there. We're going to learn more about that shortly. But Alasdair, thanks for coming on Crush the Street with me today.
That's my pleasure, Kenneth.
Let's talk about what's going on this week. I mean, we can get into what's happened with the virus earlier on, you know, all the things that have led up to this. But I really want to dive into the correction, the crash that we saw with gold and silver this week. You know, what's going on the COT reports? You know, do you see this as manipulation or just normal cycles of gold and silver markets?
Right. Well, there are two opinions, basically, going the rounds. The first one is a trader's one, and that is that the market is very overbought and vulnerable to a correction, and they've been calling this correction for the last $200. Now, if you follow technical analysis, you will understand all the indicators that show it's overbought and due for a decent reaction. Some people even apply Elliott wave to it, and they say that, you know, we're due for a fall and then we'll get a move up and so on. The other point of view is the one looking at the evidence, if you like, the commitment of traders' figures. And they show something very interesting. And that is we were going into record territory with hedge funds not long of the market. I mean, not long in the sense they're overbought. Their position was broadly neutral. In other words, they were long a net 110,000 contracts, and that was it. That is the neutral position. Now, this is important because the way bullion bank traders work is they wait until the hedge funds are in there. And these guys are just trend chasers. They're not actually interested in having a long-term position. Probably what they're doing is they're saying, oh, I think the dollar's going to fall, sell dollar, buy gold. And then when they think dollar's going to bounce, sell gold, buy dollar. You know, they're completely neutral about gold, silver, euros, swaps, anything. I mean, they really are neutral. They just use them as vehicles, if you like, for short-term strategies. But what tends to happen on COMEX is that the hedge funds build positions and they gradually all end up going in the same direction. Now, the moment that there's a pause in the market, they are vulnerable to a change in trend, which of course the bullion banks who are short to them are very keen to engineer. And it's very easy for them. You get a bit of a pause and you say, right, okay, let's bang it and see what happens. So they mark the price down and they begin to trigger some stops, which of course, naturally, the hedge funds put in. But it's their own worst enemy, because then what happens is that, you know, stops trigger more stops trigger more stops, and so on it goes. So that is how you get a situation where gold appears to rise on a wave of buying from hedge funds, and then it just collapses. And the hedge funds end up even slightly short in extreme examples, and then they get squeezed the other way. So actually, they're the patsies for the bullion banks. And it's a lovely game. And the bullion banks have been making so much money doing this because they job along the way as well. They've been making so much money on this that their positions have built up and built up and built up. Now, last year, we got to the point where open interest hit nearly 800,000 contracts. And that was by a long, long way, a completely new record level of open interest. That was getting too much. If there was a coordinated hit on the market. That was the gold price was hit, open interest slammed down and went all the way down to under 500,000 contracts. The price of gold initially went off. It fell to, I think it was about 1,470, something like that. And then open interest continued going on down, but guess what? The gold price started going up because the underlying problem is there is no physical gold easy to access. It's actually gone in London. What's happened in London is that the bullion banks, they store gold. You'll find that the LBMA have said that no problem, in London we got 8,400 tons. Yeah, but most of that is central bank gold, which is earmarked. In other words, it is not available unless it's by special agreement it is leased. And in this environment, I can tell you central banks are less keen on leasing. You've got ETF gold, which is now enormous. I mean, I think it's around about 2,800 tons, roughly. On top of that, you have got privately owned gold, which is stored in vaults like Brinks, Loomis, Malka Amit, and so on and so forth. So you can see that all the gold in London basically is spoken for. There is no liquidity. So when you get people beginning to realize, my goodness, we've got to have gold because fiat currencies are going down. The Fed is printing money like Billio. It said it will continue to print without limit. And this was the statement on the 23rd of March when everything turned round, incidentally. People are now standing for delivery. They want the physical gold, and it is basically breaking the paper system. So coming back to what we're seeing now, you've got these two opinions. The one is technical analysis. It's overbought, and therefore it's due for a fall. And of course, you've got the other side, and that is an absolutely rotten background as far as the bullion banks are concerned. They are desperate to close their shorts. Not only that, but their bosses, whose balance sheets are way out in terms of size relative to equity, they want all their traders basically to reduce their positions. So there is pressure to reduce their positions. We now come to this little bit where they would love to believe the technical analysis, this is very overbought. If we bash the market, we can trigger some stops. And that basically is what happened over the last 2 or 3 days. And I would not be surprised if hedge funds, going back to what I was saying earlier, are thinking, time the dollar had a bounce. Okay, we'll sell gold by dollar. So I think that there have been short positions taken out by the hedge funds, which actually will reinforce the squeeze in gold later and make it considerably more dramatic. So I would see this reaction. I don't know how long it will last, but I think it is a short-term event. And if I can just say something about silver, silver is fascinating because, as you pointed out, it rushed up to, I didn't quite see it at 30, but certainly close to $30. So that was a hell of a move. Now, what's going on in silver is you've got one big ETF, and that's SLB. And they store their gold in London. The gold that they store in London is a bit less than half the total in all the vaults in London. Who are the other owners? The other owners basically are industries who consume silver. They, they're not in the business of selling it back into the market. They have bought it. They are storing it. They don't want to have it on their own premises. It's too valuable to do that. So they leave it in the vaults in London. And they're not sellers. You've got SLV, people rushing in and buying new shares in SLV day after day after day. SLV going into the market, trying to acquire more physical. And that explains the most amazing squeeze on the bullion banks. It is interesting that the bullion banks in silver are not playing games. They have desperately tried to stay level in this one. And broadly speaking, they are. I think the last time I looked at the swaps, there was something like minus 5,000 contracts. Not very big in the scheme of things. It's actually pretty small. So it's interesting. It is a pure squeeze between the SLV buyers, if you like, SLV having to cover the position in physical silver, but finding actually there's no physical silver there, no one is selling it. So they're having to bid the price up. So that by and large is the position in both gold and silver markets at this moment.
Wow, what a great summary on that. Alasdair, talk to us a little bit about what the bullion banks are doing on the rise up. Now, you talked about kind of how it pauses, they slam the price down, they profit from that. The hedge funds, you know, the short, the positions, the stops that get triggered and whatnot, and the cascade that takes place. But talk about the rise up, if you will. Maybe what to expect. What do you expect the bullion banks to do in the rise up?
Well, I mean, I think I've described enough how they have played this in the past. Their profits come from a mixture of jobbing the futures contract, and also that slam down once the whole thing just gets a little bit too crazy. We're now in a situation where the buyers in the market, who are very different from the hedge funds, on the non-reportable category. Now, these basically are players in the market who don't fall into either producers and merchants, swaps, which are the bullion banks, or managed money, which are the hedge funds. So the non-reportable category is an interesting one. We don't know who they are. But I noticed with great interest that when the price of gold bottomed out on, I think it was around about the 23rd of March, the people who were long were these non-reportables. They were record long, and they were right. And this is the interesting thing. They've now been increasing their positions again in all this hiatus. So I think these non-reportables are the people who are standing for delivery. Some people have suggested that the standing for delivery is a result of arbitrage between markets. I don't actually buy that. It looks to me like there is genuine money going in using the future as a method of obtaining delivery of physical gold. So this leaves the bullion banks with a huge, great problem, because they're short and they've got no one to sell to buy their longs to cover. So this could lead actually to a very severe crisis for some of these banks. I mean, if you look at the net position on the last commitment of traders figures, the net short position was over $50 billion. It was about 38 billion net, and that's spread between about 25, 26 bullion banks. That's a lot of pain for each bank. And of course, it won't be evenly distributed. Some banks will be really in trouble. Others will be in trouble, but, you know, sort of thinking, well, we can live another day.
What do you suggest? What sort of percentage does this make of the bullion banks' profitability and you know, in terms of what they do? Is this like their main source of income versus, you know, other parts of the business that they're part of? What would you suggest?
Well, bullion banks are all divisions, subdivisions, if you like, in larger banking operations. So, you know, we would describe in the London bullion market, one of the leading players is JP Morgan. But as we know, JP Morgan does all sorts of other things. It is an enormous bank. So it's the same with every bullion bank. They're all subsidiaries of larger banking operations. So somewhere in there, they have senior executives looking over their shoulders, watching what they're doing, and either very happy with what they're doing or not happy with what they're doing. And they've got a further problem, and that is all these banks are so overexposed to global economies that are now crashing. I mean, you know, the bad debts. Think about the bad debt problem, if you like, in the other sides of these megalith banks. They have got enormous problems. They want to reduce their gearing. So where can they reduce their gearing? Can they go into the non-financial market and say to people, look, we're going to, you know, sorry, we're going to have our money back, and bankrupt even more people and make the position worse? Or do they look at their financial activities and think, hold on a minute, I wonder if we can create a little bit of room on our balance sheets by reducing our activities in foreign exchange, market making, bond trading, gold and silver trading? Do you see where I mean? So you've got this clampdown coming, and I think that part of the strength in equity markets at the moment is liquidity being withdrawn by the investment banking community, if I can call them that, trying to create balance sheet space, while at the same time the trend chasers are still tracing the trend up. So you can see that, you know, you've got a rising market on lack of liquidity. Why is the lack of liquidity? Because all these banks are basically trying to cut back on their commitment in financial activities.
So, given the circumstance that we have, what sort of upside do you see in gold and silver? I know that's a tough thing, price projections, and I'm not asking for a specific price projection, but I guess what I'm asking in a general sense is how far below the water is the beach ball, in your opinion?
The way to understand what is going on price-wise is it's not so much gold and silver rising, but it is the purchasing power of paper currencies collapsing. Now, this is obviously something that varies from, let's say, the purchasing power of dollars in gold, oil, I don't know, beach balls, whatever. The purchasing power will vary,
Mhm.
obviously. But the signal that we're getting from the rising gold price is that the purchasing power of paper currencies is going down. And if you look at what central banks are doing, it is absolutely clear they are committed to printing however much money it is required to keep financial asset prices up. There are two reasons for that. The first is the one in which Alan Greenspan spoke about when he was at the Fed, and that is the wealth effect. If we can make people feel wealthy, then they will have the confidence to go out and support a buoyant economy. That's one. But the most important one, which is not spoken about, is that the Fed has to finance the government deficit, which basically means that it needs to ensure that the government can fund itself. It'll be funded through inflation. I mean, that's got to be admitted, through QE or whatever, but at the lowest possible cost. And they have progressively reduced the level of interest rates that apply to bond markets, the yield on bonds, to the point where well, I mean, it's under 1%, a long way along the yield curve in US dollars, and also in the Eurozone, it's below zero, and in Japan, it's below zero as well. So they've come almost to the end of that road. So we now have monetary inflation on steroids. The purchasing power of paper currencies is being undermined, and at some stage, the yields on government bonds will rise when people realize what is actually happening to the purchasing power of money. Now, where gold and silver come in this is it is the advance warning of what is going on to the purchasing power of paper currencies. So I think that there is no way out of this for the central banks, because they will have to print and print and print. At the moment, that money isn't getting into the underlying non-financial economy, because banks are standing in the way with balance sheets which are already overstretched, and they are unwilling to stretch them any further. There will be a banking crisis. There always is at this stage of the credit cycle. And this crisis will be enormous. And in fact, I'm putting out a note tomorrow identifying the major banks which are probably at the greatest risk of failure. Now, that I think can happen anytime from now. It could be a matter of a week or 2 weeks, probably not very much longer than that at the outside. Now, if that is correct, and I am convinced that is correct, then the effect on the purchasing power of paper currencies will be hit through the foreign exchanges. It will also be hit through rising commodity prices, oil, copper, which are already turned around and going higher. We'll see more in gold and silver. And there will come a point where people in America, for example, suddenly realize it's not the price of food going up. It's not the price of oil going up. Actually, what's happening is the purchasing power of my money is going down. Now, the moment they realize that and they start dumping it as something that is going down, then all hope for that currency will be lost. So coming back to answering your question, what I expect to see is priced in paper currencies, gold and silver, will get very close to infinity. So, but it's not so much gold and silver going up. It's basically paper currencies being completely trashed.
It's not funny and it's not crazy. You bring up facts, and you talk about these things and you present the case. Have you been able to bridge the gaps between, the gold and silver community and the mainstream financial media or anybody on Wall Street? I mean, what has your experience been communicating these thoughts and this analysis to maybe a more mainstream audience?
Well, I'm finding that ordinary people are beginning to latch on. And, you know, one of the things that's helped has been the cryptocurrency phenomena, if I can call it that, phenomenon. People have now been educated to understand that the reason that you buy something like Bitcoin is because there is a limit on the number of Bitcoin that can actually exist. And this contrasts with paper currency, which are completely limitless. And therefore, if you want to hedge out of the weakness of paper currency, you go and buy Bitcoin. Now, I'm not making an argument for Bitcoin, but what it has done is it has educated people to something which they would not have understood before. And I think that the overall effect of that is that people understand this a lot better than, if you like, economists and investment managers. Now, the reason for that is that economists and investment managers are basically all Keynesian. They're all inflationists. They're sitting here, they're saying, if the Fed doesn't get money going into the economy, if it doesn't manage to reduce interest rates, get more money into the economy, we're doomed. And actually what they're saying is, we believe in inflation. Inflation is the only answer to all economic problems. That is what they believe. Now, because they believe that, they're not going to listen to my story about gold and silver. And furthermore, a lot of these people work in bullion banks who don't actually understand the characteristics of the commodities with which they're dealing.
So do you suppose it's just a cognitive dissonance? I mean, these aren't dumb people. You know what I mean? These aren't people that I would think are unreasonable. Do you think there's just this hand that they're dealt that are saying, hey, you know, it's like a politician, you know, implementing policies because they have 4 years to act and they need to go with the trend. And the trend is mainstream and not gold and silver.
Well, let's stick to economists. I mean, I look at someone like Paul Krugman, who is a high priest of Keynesianism. I mean, he really is. He believes in inflation. He doesn't believe that people should be rewarded with interest rates. He is totally in favor of the socialization of money. Now, someone like Paul Krugman is not going to believe anything about, let's say, that comes from classical economics. They will only believe that Keynesian paradigm. It's rather like he is the high priest of a religion. He has belief. He doesn't have a theoretical construct under it, which is credible. And that is the difference. If you, particularly with Austrian economics, which, if you like, is the extension of classical economics, you have, you have theories which are grounded in fact, grounded in human action, if you like. But when it comes to macroeconomics, which is really what we're talking about, that is not grounded in human action. It's grounded in aggregates. And the assumption is that people in aggregate behave differently from how they behave as individuals. And this was basically the proposition put forward by Keynes in his tract on his general theory, published in 1936, when he dismissed Say's law. Say's law basically says, well, he redefined it, so it was gobbledygook, but you know, putting that to one side, basically what Say's law says is that we specialize in what we're doing in order to be able to buy the things that we're less able to produce, so that way we maximize our output. So we make things to buy things, and the role of money is purely to affect that transition, if you like, from what we make to what we buy. And I mean, that's common sense. Yet the Keynesians deny it. I mean, I remember getting into correspondence with one of the leading Keynesian journalists in London. And he started off by saying, you know, because I wrote a letter to this newspaper, and I quoted Say's law, and I said that, of course, you know, nowadays people don't believe in Say's law. And this chap rose to the bait and he said, I certainly don't believe in Say's law. And this is one of our leading journalists. But it's all round. I mean, there is a huge difference between macroeconomics, which is, you know, uses government statistics blindly and believes in inflationism. There's a big contrast between that and classical economics and the theoretical economics, which was devised, well, particularly developed by Ludwig von Mises and a few guys before him, you know, that is what makes sense. That is why this whole thing is falling over. We can predict it, understanding classical economics and the extension of it through Austrian economics, whereas people like Krugman can't understand it. And I remember Stiglitz praising the previous Venezuelan leader. I'm trying to remember. It was Maduro's the current one, but the guy before him, Chavez. That's right. You know, his policies, you know, because they were inflationist, he thought were exactly what Venezuela needed. Now look at Venezuela. I mean, for goodness sake.
Yeah, Alasdair, it's amazing the things that you're talking about and the way people act when it comes to the government. I do a lot of thinking about that, and I can only imagine how much damage has been done in confusing the overall population with how things should be done, with what we've seen just this year alone in 2020, the response from governments to help people, keeping them locked down and to throw trillions of dollars into the system. How confusing is it to watch the stock market bounce back, for people to have all this extra spending money in certain instances? The unemployment, people getting these unemployment checks and having more money than they did prior to the issue. So I don't know what to expect going forward here. I know there's a big presidential election coming in November. There's probably going to be a lot of change that happens regardless, one way or another. And I think people are being conditioned to be confused by the economic situation. It's already nuanced enough, but then to have these actual experiences where the government sends me money and I feel good about that, the stock market goes up, things are moving along, I don't think people can connect the dots on what's fundamentally driving and what's going to build a foundation for the future that's long-term sustainable.
Well, at the moment, it's being driven by money created out of thin air. And there's always a pause between the creation of money out of thin air and it actually having an effect on underlying prices.
And that's a problem, because that disconnect, that lag, people don't make the connection.
No. But having said that, I mean, when you get helicoptering money, as it were, which is basically what you're doing, or what President Trump is doing, the effect on prices tends to be pretty immediate, but it's immediate only on those prices of the things that people buy with that helicoptered money. And I noticed that food price inflation in America is beginning to rise rather alarmingly. I would expect that, because that's where a lot of that money is being spent. And I think, you know, while there are people who would sort of, you know, maybe find $1,200 and whatever, you know, is a lovely gift and all the rest of it. I mean, we've got to bear in mind that something like 80% of employees in America live paycheck to paycheck. So actually, this money is just basically allowing them to feed their families. The idea that this money is, you know, somehow sort of added to savings and all the rest of it is probably only true for pensioners, if they get it. I mean, I don't know enough about this helicoptering thing to know whether pensioners are included in it. But if they are, then they're not going to change their spending habits. So they got an extra $1,200. That's brilliant, lovely. They'll just bank it. But for the ordinary person, the consumer, if you like, because the consumer is also the producer, you know, he's living paycheck to paycheck, or at least 80% of them are. And that is a very, very serious thing to understand in all this, because the effect of this is to push up the prices of the things that people need. And the reason is because everybody, or at least 80%, are in dire trouble on this COVID lockdown.
You know, Alasdair, we tend to see this money go right into the stock market whenever the government eases interest rates. They print money, they inject it into the system. So, I mean, what are your thoughts on this? Is there a disconnect, a permanent disconnect between what the prices of stocks fundamentally are, what they have historically been, and maybe a new paradigm of stocks are a way to hedge against inflation, this dollar crisis?
They're not. It's a dislocation, if you like, of money flows. Money is going into financial assets. It's not going into the underlying economy. The underlying economy is going bust. Meanwhile, money is bottled up, if you like, in financial assets. And this will be unlocked, I believe, by a credit crisis, which, as I said earlier, I would expect to happen any moment. I think the effect of the credit crisis is that banks, all banks, will probably come under the conservatorship of the state, either directly owned or directly guaranteed. And then the Treasury can tell banks to push money in to save this business, that business, and so on and so forth. So the money will then start flowing into the underlying economy, but it will be starting to flow out of financials. I think that the potential crash in equities could be absolutely enormous, even though at the same time people might be saying, well, you know, if we get out of money, we get into equities, we're buying real assets. No, you're just buying financial assets. Equities are not yet any form of protection against inflation. They have become wildly overvalued, and that is a situation which will regularize itself, and I think it will regularize itself on the back of a banking crisis.
Yeah, and it's such a nuanced situation. I mean, even Warren Buffett has had this conundrum of buying Delta because he thought it was valued properly in February, selling it at a low, and then watching the stock price go up with the trillions of dollars thrown at the system. But, you know, again, he's saying it's not properly valued. We're in this disconnect, this dislocation, as you called it. And I would agree with you. But it's definitely another confusion to this situation, this understanding of true fundamental economics that we're trying to get across to people. It's all this disconnect. I mean, Zoom, Facebook, Amazon just going to record levels, Tesla. Again, all of these crazy valuations is another problem for trying to get this message that you and I are trying to get across to people. So I guess let's share some closing thoughts here. What you would advise to people, some closing thoughts, and then afterwards, let's get into goldmoney.com.
It's quite simple. We've been advocating sound money. I mean, the reason that we advocate gold is because gold is sound money, but the basic application is for sound money. So you need to escape, if you like, from this hell that has been created by what will end up in the complete collapse of paper currency. I'll draw a parallel for you. The time in history when this happened before was in France in 1720. There's a Scotsman called John Law who managed to persuade the regent, the Duke of Orleans, to accept his scheme. And what he ended up doing was he set up a prototype central bank in the Royal Bank, and he acquired all the foreign trading rights for France, which were tied up in something which we know today as the Mississippi Venture. It was about February the 28th, 1720, the Mississippi Venture and the Royal Bank were going to merge. Now, the top of the currency was actually in November 1719. This scheme was beginning to run into trouble because basically what he was doing was he was printing money to buy the shares in the Mississippi Venture. So what's the Fed doing? Printing money to buy shares, stock, in the government venture, the US government venture. So it's exactly the same thing, but it's on a far larger scale. Now, the bad news is that John Law's scheme had failed by the autumn of 1720. The shares still had some value, and indeed the companies continued to trade for some time afterwards. But the value of the livre, the paper livre, in London had no value at all in September of that year. Now, this basically what I'm saying is that the foreign exchanges said that the livre was valueless, and that was in September. The peak of the shares was in February that year. By September, the whole thing had gone. Now, the lesson is that if you tie a currency, a paper currency, to financial asset values, and you want to sustain those financial asset values by printing money, then you will destroy both the financial assets and the currency. And that, it seems to me, is to be where we're heading. So take protection accordingly.
Real quick. So to that degree, and are we tying a dollar value to gold because that's what we value it in? And we cannot, gold is an ounce and it retains its purchasing power regardless of what the currency is. So couldn't you say the same thing of a security though? Does it matter what we're buying it in? I mean, doesn't matter that we're using dollars now, but if the dollar goes worthless, it's just going to be revalued.
Sorry? Really? No. Now, what I'm saying is that if you tie the dollar to, in this case, US Treasury bond yields and the wealth creation effect in equities that follows on from that, once those financial asset values start going down the pan, which they will, and it'll start with foreigners selling the dollar, and we're already beginning to see that, then the effects will be to destroy the currency as well. Now, you're referring to gold. I mean, the best way to avoid being caught in this maelstrom of collapsing dollar and all the other currencies that are tied to its coattails, the best way to avoid being caught into that maelstrom basically is to own physical gold and silver outside the banking system. Because if you've got it in the banks, you don't want to have a dispute about ownership of your bullion, which the bank is looking after for you.
100%. No, and maybe I didn't get my point across. If you have a security and equity and the dollar collapses, you know, even though we price this security in dollars, I mean, if the dollar's collapsing, won't it just be reflected here? The value is still what it is. I mean, Coca-Cola is still selling Coke, so they'll have to just charge more, or maybe they'll start charging in gold, or, you know, whatever. But the value is the people hours, the assets, the equipment, all these different things. I mean, why would what it's being priced in matter? Well, you know what I mean?
Well, yeah, I mean, okay, well, looking at Coca-Cola's problem is that fewer people will be buying Coca-Cola. That's their first problem. I mean, we don't know how this will work out. I can tell you that the governments will do everything they can to resist the collapse of their paper currencies, except the right things. The right things basically are to allow interest rates to rise, to reflect what's happening to the currency, to let businesses go bust and stop supporting them, to bring back their finances under control, and that is crucial. The idea that you can run huge, great budget deficits in order to reflate the economy, that has to finish. And then in the longer term, the government has to plan to reduce its involvement in the economy from, I mean, if you look at the UK at the moment, we're about, I think, 45% of the economy GDP is actually government actions, government activity. That has got to be reduced down to somewhere less than half of that to have a sustainable working economy delivering for people in the longer term. So, you know, it's a combination of things from the government point of view. So the question then is, how long is it before the governments and the people who vote for them are prepared to accept the medicine? And there will be a lot of political turmoil at that time. It is possible, if you get someone who actually does know what they're doing, to turn the thing round. And I think the classic example of this was Erhard, the economy minister in Germany, just after the Second World War. I mean, he took charge of the thing and did an extremely rationing and all this sort of stuff. He stopped all that within about a week. I mean, you know, it wasn't as good as it used to be, if you like, but I mean, certainly normality returned within a week. Shops opened. They had goods to sell. It was remarkable. You won't get governments going down that route because they really do not understand how it works. They must have control. That is the point about government. We must control what you do. And only then can we ensure your safety. You know, advert for government over.
Alasdair, if people want to learn more about you, goldmoney.com, please let them know where they can go and what they can expect to find.
Okay, well, goldmoney.com, basically we store precious metals for our customers outside the banking system in proper, secured, insured vaults, you know, the normal sort of stuff. I think we've got about $3 billion worth in custody at the moment. So that's, you know, I mean, we're not a huge player, but we're beginning to be, I think, quite important. We're helping quite a lot of people protect themselves from what's going on. I personally, I'm head of research at Gold Money, and I write an article which is published on every Thursday afternoon EST. So if you go to goldmoney.com, insights or research and then insights, you'll find my article there. And I also do a market report on Fridays. So, and that is, if you like, under research and then market report or something equivalent to that. So that's who we are, and that's what I do.
Alasdair, thank you so much for coming on the show and sharing your knowledge with us. I appreciate the stories, the history, the analysis on the COT, what's going on with the bullion banks, and the pertinent timing on, you know, just explaining on what's happening here, because I think a lot of people are going to really appreciate what you had to say and just this analysis. So thank you again.
Thank you for having me on, Kenneth.